Okay, let's go.
Many traders build perfect technical setups, only to watch the market snap backward, triggering a sudden and violent drawdown. Relying on geometric shapes, like M patterns or head and shoulders, often leads to failure. These patterns, when viewed in isolation, ignore the human behavior driving the candles. Markets function through the continuous generation and consumption of liquidity, not the completion of textbook drawings. A chart serves as a visual record of human emotion, mapping where the consensus acts on fear or follows greed. Institutional mechanics utilize fakeouts as deliberate tools to hunt the stop losses encouraged by these retail patterns. True price action mastery involves decoding where traders are trapped. On this heat map, glowing clusters represent pooled stop orders targeted by institutions. Institutional size requires massive volume to enter or exit, found by sweeping these dense clusters, using retail stops as fuel for directional moves. To trade effectively, you must stop predicting the direction of a shape and start locating the pain points of other participants. Without locating trapped liquidity, your own stop loss becomes the very fuel the market is seeking. Directional trends create a psychological baseline where participants hold fundamentally different mindsets. Trend followers typically exhibit higher risk tolerance, holding through minor drawdowns and reducing the selling pressure that would otherwise fight the trend. Counter-trend traders often operate under the greed of catching a high-reward reversal, but they are burdened by the fear of fighting the primary momentum. This fear forces short sellers to place tight stops near local highs. These markers show where sell orders are entered with zero room for error. Pushing through these thresholds trigger stops, providing the mechanical energy to drive the trend higher. This psychology is most visible during an all-time high breakout. Fresh breakouts at all-time highs frequently trap buyers driven by retail FOMO and late-stage news cycles. Smart money often utilizes this influx of retail liquidity to exit long positions, causing the price to stall and eventually drop. The tactical approach to an all-time high is to wait for the initial rejection and buy the first structural dip that follows. Buying the absolute breakout frequently provides the exit liquidity institutional players require. Edge lies in trading the exhaustion that follows the trap. To validate a move, we draw a band across the 50 to 60% zone of an impulse. Pullbacks staying above this zone are corrections. Buyers retain control. A candle closing below invalidates it, signaling the originator surrendered. This threshold rule defines the counting sequence for corrections within a single price wave. The first correction following a move is the highest probability entry, as it often aligns with institutional accumulation. By the third or fourth sequential correction, the trend is often structurally exhausted, significantly increasing the odds of a deep reversal. Measuring the depth of a pullback prevents you from holding a position through a total trend failure. We can also track exhaustion at the micro level by analyzing individual candle anatomy. Large solid bodies indicate institutional conviction, while long wicks signal confusion and friction in the order flow. Momentum decay often follows a specific numerical pattern. When 4 or 5 candles of the same color appear in a row, the trend is reaching a point of localized exhaustion. The shrinking bodies and long wicks show that buying pressure is vanishing. Novice traders often see a 5-candle streak as a sign of ultimate strength and buy the top just as the momentum pauses. To confirm the trend will continue, you must wait for an opposite-colored candle to form and see its high or low structurally broken. Entering during an extended uniform candle sequence means you are buying exactly when institutional flow is scheduled to rest. Every market rotates through a mandatory structural cycle. Your strategy must shift to match the phase. Phase 1 is a smooth trend. This eventually degrades into Phase 2, the volatile expansion, where early adopters take profits and latecomers fight for entry, creating massive swings. Exhaustion then leads to Phase 3, the contraction phase. Price moves sideways within a compressed range. This contraction is the action phase. Retail consensus builds and traders load up on positions right at the boundaries of the range. Traders place their stop losses just below support, assuming a breakdown is imminent. Psychological levels, such as a flat 51,000 mark, act as magnets for this pooled liquidity. Institutional algorithms identify these densely packed orders and initiate a targeted sweep. This creates the reaction. Price spikes below support to trigger the retail stops. then uses that sudden volume to reverse violently upward. This explosive move stems from the mechanical forced liquidation of trapped participants, often independent of any news or fundamental shift. To succeed, you must stop viewing charts as static patterns, analyze the phase, locate the trapped liquidity, and align your entry with the institutional reaction. If you cannot identify the trapped liquidity on the chart, the trapped liquidity is you.